Vinit is here with us from Ventura. Vinit, before we talk about markets and your stock price, the story which my colleague just broke, what's your call on the steel space as such? Just a couple of weeks back, we had a report coming in that after the dust has settled, it's Tata Steel and JSW Steel which will emerge as holding almost 40% of the total capacity in our country. Have you looked at this space closely?
So I've looked at this space closely, and my preferred play in this segment is going to be JSPL. Okay, because they're purely a long play product company. Long products are there, and long products are very insulated from imports. So given that kind of scenario and the infrastructure push that is happening and the redevelopment of India, I think this is one stock that is going to play out very well. So rather than looking at companies which have flats and longs as a mix, I think it's a preferred way to play a focused play which has got good volume growth in place, good capacities are there, and is going to start sweating his assets at a much quicker rate.
Of course, now after the QIP, they are better capitalized as well to retire debt and go ahead with their capacities, right?
Yeah.
Okay, Vinit, apart from that, let's talk about the mid-cap IT play and how you're approaching this sector as a whole. Digital is clearly going to be a big theme that a lot of the IT companies as a whole will be focusing on. Do you believe that this play is going to bode them well? Is there any mid-cap stocks that you like within the mid-cap IT space, within the IT space?
Yeah, so what is going to happen is, so to take your cues from it, if you see the large cap stocks, how they perform, and the segments which are driving the growth, those are going to be the plays where mid caps are focused on, are going to do well. Some of the stocks that I like are Mastek. It has run up a bit, but there is definitely a lot of juice left. We are going to see some more growth coming into that company. We have seen how they have defined the business of Majesco, carved it out as a separate subsidiary, and now they're focusing all their efforts on development. So this is one stock which is going to do well. KPIT is another stock which can do well. And Persistent is one of my another preferred stocks where they are very, very strong on product engineering.
Vinit, what's your take on auto ancillary space? You have discussed some of the auto ancillary stocks with us in the past as well. Today we are looking at stocks like Motherson, Sumi, etc. again smartly ahead of the board meet where perhaps the market is expecting some M&A in the American market. But otherwise too, auto ancillary the space has started to come back, mainly the CV ones, because CV cycle is doing well. What are your thoughts on any particular stock which you have had a closer look at in auto ancillary?
Yeah, so just to give you a very brief outlook on the CV industry, it has got a very promising another 2-3 years to go. Okay, and that if we bring in with a replacement scheme which the government is looking at to squash vehicles which are 20+ years old, then you're going to have another replacement cycle run out. So although we are in the mid cycle, this cycle typically is for 3 years. We could see it still play out for another 2 years, well into 2021. And a lot of the players are not able to deliver volumes primarily because they have got supply constraints. So now with the supply constraint easing out, these things should move out faster. And one stock that we like in this space is Talbros Auto. Okay, it's done an EPS of around under 10. And we see this EPS over the next 2 years grow to about 30. So there's a huge play coming in the form of gaskets, heat shields, and all their subsidiaries now resuming their growth path. One very important feature to understand is that over the last 4 years, sales have been pretty stagnant. However, there has been a lot of restructuring happening and the margins have not been squeezed. So given the fact that margins have been stable and volume growth coming in with CVs, gaskets and heat shields for BS6 vehicles, I think there is a big road ahead. Secondly, the only headwind out here is going to be, if the European and the US trade war accelerates, growth might come off a bit. But the stock is very cheaply priced, where we are talking of EPS growing from 10 to 30. Even if it comes down to 25, even if you give it a multiple of 12, because its ROE is not that, it's in the early teens. So given all these things, price target of between 350 to 400 would be a base case and a bull case scenario.
You've spoken briefly about the mid-cap IT space, Vinit, but
yeah.
Intrasoft is one stock from the mid-cap
Yeah.
IT space, which you believe is investment grade. Talk to us
Yeah.
about the rationale and what kind of returns can investors expect from it, say,
Yeah.
over a 2-year period.
So Intrasoft is a very unique company in the fact that it is an e-commerce play which is focused only on the US markets. So they sell US products in the US geography. They do not sell Chinese or Indian products in the US geography. So this is the mode that they have created. They deal with only US based vendors. The fulfillment is done by UPS there, and the money comes through from Citibank. So that kind of model that they have perfected has worked very well for them. They are a 3P player in the Amazon, and they have raised themselves to become the top 25 players or a platinum player on Amazon. So what gives it added advantage is that they get money back in 4 days. Their display is top of the line, just like you would be doing for a page one listing on Google. So any product sold through Intrasoft is displayed first. Additional to this, they have got negotiated 10 days credit cycle with their vendors, and with these kind of settings, their vendor base has gone up from 450 to close to 1900, and they have also grown their SKUs that they sell from about 2 lakh to about 7.5 lakh. So all this given looks to be good. On the valuation side, it is one of the few e-commerce plays which is profitable. Another company comparable to them, Wayfair, makes EBITDA losses. We expect that this company will grow upwards of 30% CAGR over the next 2 years, both on top line as well as on bottom line. There is significant operating leverage with all the costs of product development already built in.
Let's also talk about, some of the stressed asset space. Is there anything within this sector that you're looking at, some turnaround stories that you're seeing?
So in this stressed asset space, one stock that I have been advocating for a very long time, I have not been marketing it to investors, not as a recommendation, but there is a stock which is Jayaprakash Associates, which has got significant value built in. And if the restructuring of the stress assets comes through, substantial value unlocking can happen in that.
Right, Vinit, thank you very much for that.